From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. This bullish juggernaut in momentum continues as the drugs company Merck up 5% on an FDA approval. The rally endures. Countdown to the Open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up in the show, as I say, futures edge high. The S&P 500 eyes 5 straight months of gains. Traders brace for the Fed's preferred inflation measure. What is the tolerance for a hot PCE? And from cars to coal, Baltimore Bridge collapse disrupts trade. We begin with the big issue. Those stocks, they've got their turnaround.
It doesn't pay to be bearish, right? That data is way too good. You've got to stay bullish, and you've got to stay bullish on equities.
This is among the most record-setting periods of momentum that we've seen.
We don't have a Mag 7. We've got a couple stocks really driving it.
What we've just started to see, and I think this accelerates as we go through the year, is the rally broadens out.
We're still in a bull market, and I think you stay invested.
Well, RBC's Laurie Calvasina writes this. We continue to see sentiment as stretched. We think the U.S. equity market pullback is overdue, but the risks of a melt-up, particularly given the dovish Fed meeting, the rapid increases in 2024 GDP that are underway, have admittedly grown. Laurie joins me now alongside Allspring's George Bory. Good morning to you both. Laurie, good morning. It's a juggernaut. It's a momentum juggernaut that just seems to be unstoppable at the moment. What would materially flag stretched to you? Good morning.
Hi, so thanks for having me. And look, I think the sentiment indicators are what have us worried tactically a little bit in the short term, though frankly, they've been worrying me for a few months. I would keep a close eye on AAII net bullishness. It's been hovering around 1 standard deviation above the long-term average. When we wrote that sentence you just highlighted, one of the things we had in mind is that that indicator sometimes does go to 2 standard deviations, not all that often, but occasionally. And we think the risks that that particular indicator may see that 2 standard deviation mark before all this is said and done have risen. It's not an absolute, but the problem with that is when you do go to 2 standard deviations, stocks are typically down over the next 12 months. When you're at 1 standard deviation, stocks are typically flat over the next 3 months and then up a tiny bit over the next 6. So or over the next 12 rather. So I think that where we are right now makes the case for a short-term pullback and then getting back to business with the rally. But if we do have that melt up, it might be giving us more of a negative long-term signal down the road.
OK, well, there's miles to go. Laurie, stay with me. George, good morning. You said it started so well. It was the perfect Goldilocks scenario for the bond market. Then, of course, you had that slight of warmer porridge with the PCE disrupting the January and February momentum. This tolerance or this building narrative that we've all got, we just had Mr. Clarida on surveillance a moment ago talking about the tolerance for slightly higher inflation from the Fed. Do you buy that?
Yeah, good morning. Thanks for having me on the show. We've had a long-standing view that it would be very difficult to get inflation all the way down to 2%, and that the true natural rate of inflation in a developed economy is much closer to 3 than to 2. But policymakers need the market to believe that they are willing to get inflation down to 2%. And it's really that market confidence that we think the Fed, has both done a good job managing and does seem to be, at least on the margin, kind of willing to start to test the market's sort of willingness to accept, perhaps more of a range of around for inflation rather than just a point estimate that they're determined to drive to. So we do think, sort of markets are, pretty dynamic, bond markets in particular. The long-term sort of inflation expectation numbers are still fairly well anchored, which to us, is a strong vote of confidence, both for what the Fed's doing today, where rate policy currently sits, and then sort of what the Fed has guided the market to expect. So While, inflation is certainly a little bit higher, well, a fair bit higher than target, it is sort of pointing generally in the right direction in that it is very slowly coming down. And as long as that trend persists, we think that should work to the benefit of bond investors. George,
are you uneasy in any way when you look at the 5-year break-evens cascading higher?
Uneasy that they might cascade higher, I suppose. I mean, we do watch, obviously just sort of the near-term inflation indicators pretty closely to determine, sort of what's the trajectory. We, like everyone else, sees upward creep in sort of super core prices, but broader context, when we look at, say, kind of manufacturing or goods prices still coming down while services go up, to us tells us we're very much in a transition phase where the economy is sort of shifting in a fairly dynamic way. There is still clearly some price sensitivities within the economy, but on a more broad-based basis, we do expect inflation to remain fairly well behaved as we go forward. And, we think that while you can see some upward drift in some of the break-evens, we don't expect a meaningful breakout. So from that perspective, no, not panicked.
Okay, it's good. It's good to know that you're not panicked, Laurie. The issue for you very clearly say we're priced to perfection. You put your hands up for the melt up in 5,500. I just wonder how much of that narrative would or possibly be interrupted if the Fed scales back to 2, or even in a Bostic scenario, just does one cut. Excuse me.
So, look, I think from my perspective, if we were to sort of dial down the pace of cuts that's expected or the number of cuts that's expected, with sentiment sitting where it is right now, we're looking for the potential for some sort of trigger, right, to come in and kind of take a little bit of froth out of this market. So could that do the trick? Absolutely. We, though, frankly, did dial down Fed expectations a good bit earlier this year, and that didn't seem to make a dent. But there aren't a lot of potential negative catalysts out there. So I think that's one that you have to keep on the radar.
Now,
from my perspective, though, when I think...
Yep, sorry, go ahead. Please finish.
Go ahead. No, I was just going to say, from my perspective, though, I really care a little bit less about whether it's 2 or 3. Maybe 1 wouldn't feel so good. But I think the important thing from an equity market perspective, kind of on a 6 to 12 month view, is really just to go ahead and get the cuts started. I think the actual number is probably less important.
Yeah, and then we can spend the next 6 months debating what scale of this cycle, whether it's the traditional 200 or not. Laurie, I love what you wrote this morning. There are signs of fatigue with the mega tech growth names. Now, this is almost heresy coming on this show saying this, but you make the point. It's about dynamic leadership. It's about the leadership in the U.S. equity market is itching to rotate. What's the risk with a deep rotation, or what is the benefit from rotating now?
So, look, I think you really have to be specific when you talk about the potential for leadership to rotate. There are some folks out there who are, you say, something else is going to work. They automatically have in their head the picture of these Mag 7 stocks going down 10%, and that's going to tank the equity market. And that's not what rotation has to look like, right? It could be some of those big mega cap tech names that have done so well simply treading water, simply not leading, not going up as much of the rest of the market. So I think there are scenarios where a leadership shift could take the market down. I think there are scenarios in a leadership shift that simply could allow the market to go up with different things leading the way. And I'm probably more in the latter camp, notwithstanding my short-term pullback concerns, because if you look very simply at a PE chart, on the top 10 names of the S&P 500, the weighted PE, or the equal weighted PE rather, is somewhere between 27 and 28 times. If you look at the rest of the S&P, and equal weighted PE there is about 16.5 times or so. And so I really do see, in terms of the seeds of that data, the case for a catch-up trade in the rest of the market. The rest of the market is, sort of sitting at levels way below past peaks. The top 10 names are sitting up at peak valuations relative to the last 10 years or so. And then I've seen this time and time again in equity markets where you just simply have one piece that needs to catch up, and it can extend the rally a bit.
And then if we flip it over to the bond side, if we do get any kind of a drawdown, George, it may well pay dividends to be long of duration now. But the market narrative over the past couple of days seems to be steepeners. Now, we lived through that in the back end of last year, and a lot of people got smacked, to say the least. You have a slightly different perspective. You talk about a reverse twist with the front end lower.
Yeah, no, we think right now, I think from a bond market's perspective, I mean, a couple of things to keep in mind. We emphasize very clearly bonds are doing exactly what they're supposed to do: steady, stable cash flows. Bonds are not growth investments, they're cash flow investments. And so if you can maximize income right now and add a little bit of duration, you're doing okay. You're just compounding at a relatively high rate. And when we look at aggregate yields anywhere from, say, 4 up to 8% across the traditional publicly traded bond markets, when inflation's roughly around 3% or so, you still see very attractive positive real yields. When we sort of build portfolios that'll capture that income, carry it through time, we see very nice kind of compounding effects. Plus, when we add a little bit of duration to the portfolio, like we saw at the end of last year, kind of a brief pullback, if you will, or just a pause from a bullish perspective when folks think about the economy, if we were to see a little bit of softness on the labor front, or even just a little bit of a slowdown from a growth perspective, then that duration becomes very, very beneficial. So we like the income. We find very generous opportunities to use it to build good portfolios. And then we view the duration position as a little bit of a hedge against the potential for a harder landing.
Laurie, I can't let you go without just at least getting an opinion, not so much about the DJT stock in of itself. I'm not asking for a deep analytic on that, but it is quite a phenomena that we've had this reverse SPAC. The stock is up again another 16% this morning. Do you think that's a political narrative that's driving that stock, or is it something reflective of mania in markets?
So, I'll be honest with you, I've not looked at that at all. What we have been talking about in regards to the election is that if you look at the betting markets, you're actually starting to see Biden make a little bit of a move. Trump is still ahead, but we are starting to see a little bit of a shift there. And I know that Bloomberg had, an interesting sort of
we had the morning consult poll yesterday that showed Biden ahead. The economy is feeding through. And indeed, he is pushing through. The blue wall seems to be momentum. That's a shift, isn't it, Laurie?
It is. And, it's really interesting because if I think back to my conversations all the way back to last summer with non-U.S. investors, and I'll say this is mostly non-U.S. investors, not U.S. folks, but there has been a big view that there is going to be a Republican sweep in the U.S. and that the White House race was a done deal for Trump. And I would say that's not been quite the view among the U.S. investors I speak with. I think they're a little bit more confused about what the outcome is going to be. But for the non-U.S. investor, these moves that we're starting to see in some of this data, whether it's betting markets or your polling data, I think really flies in the face of some of the assumptions that non-U.S. investors have been making when they've been looking at U.S. equity markets. So it's a shift that we really do need to keep an eye on here.
OK, team, thank you so much. Laurie Calvasina and George Bory on the markets this morning. One major market move has been in dollar-yen. The tolerance level at the Bank of Japan, the Ministry of Finance, along with the regulator, it became too much to bear. This is a currency which dropped by 4% over the past 2 weeks. Suzuki, the finance minister, says we're watching these moves with a high sense of urgency. And so down went the dollar. It was lower at one juncture this morning, I should say. We traded up at almost 152, which is a big break point in the market. Kanda said we cannot tolerate speculative moves. What will they do? What will they do? This is the euro down, the yen rallying, and indeed you've got 10-year yields. Will they intervene as they did in 2022? They spent $60 billion. I put to you an outlier risk. We could always raise rates. There you go. Let's take a look at some of the stocks moving ahead of the opening bell. Abigail Doolittle is with me. Abby, good morning.
Good morning, Manus. Let's start out with yesterday's big winner, and that, of course, is Trump Media and Technology. The stock yesterday closing higher by 35% in its post-SPAC merger debut, its first day of trading. Today, in the pre-market, up another 19%. This is the most expensive stock to short for a number of reasons. And at the end of yesterday, this unprofitable company had a valuation of $7.9 billion. Robinhood up 8%. They've unveiled the Robinhood Gold Card, which will be offered exclusively to members of the firm's subscript. It does offer 3% reward back, and they are planning, according to the CEO, to enter the market in a big way. Talking about big way to the downside, GameStop down about 15%. They put up a double-digit revenue and earnings misses. Baird is saying that the results are disappointing and that there are clear challenges to their retail model. Manus.
OK, Abby, thank you so much. Coming up, the latest out of Baltimore following the collapse of the Francis Scott Key Bridge. You're looking at a live picture there now. The Maryland governor saying the top priority is recovery, bringing closure to families. We'll give you an update on the ground. 6 people are presumed dead. We will continue with that story in just a moment.
told them we're going to send all the federal resources they need as we respond to this emergency. I mean all the federal resources. And we're going to rebuild that port together. Everything so far indicates that this was a terrible accident. At this time, we have no other indication, no other reason to believe there's any intentional act here.
We're looking at a live shot of the collapsed Francis Scott Key Bridge in Baltimore. In the last hour, the Maryland governor, Wes Moore, said the top priority is recovery, bringing closure to those families. He reiterated that it's still too early for the investigation to speculate on criminal charges, as President Biden there pledges to cover the entire cost of rebuilding. Kayleigh Lyons is with us now on the ground. Kayleigh, I mean, still 24 hours on, we had quite a long, extensive news conference yesterday, 24 hours ago. How much progress has been made logistically? And this could have been a lot worse if there hadn't been that Mayday call.
Absolutely, Manus. Of course, it was 7:30 p.m. Eastern last night when the Coast Guard called off the rescue attempts. It is now a recovery operation that has been underway now for about 3 hours this morning. It began at 6 a.m. They are trying to recover these 6 individuals, construction workers who were on the bridge at the time that it collapsed, and try to bring some closure to their families. Maryland Governor Wes Moore said today that is his top priority. Of course, as you allude to, Manus, we also did hear from the governor repeatedly yesterday as well as today about the response of first responders upon receiving that Mayday call, stopping further traffic from coming onto the bridge before it collapsed. That likely saved many lives, but sadly, tragically, it does seem presumably now that 6 lives were lost. Of course, also today, in addition to the recovery effort, which is ongoing, we do expect that the NTSB, the National Transportation Safety Board, will board the vessel and conduct a thorough investigation into what exactly happened on board the Dolly before this collision and ultimately the collapse. That investigation will be underway with a 24-person team working on it. And of course, after recovery and investigation, then it is going to be a long effort to clean this up, to physically get this large ship out of the waterway, out of the harbor, and then get all of the debris out of the water as well. It is likely going to be a lengthy period of time before they can reopen the port of Baltimore, which of course is the crucial waterway for imports and exports. And then of course, reconstruction is a whole other animal, Manus.
Indeed, and that's the point to which Biden spoke about. The politicians are already arguing about the amount of money that was allocated under the Infrastructure Act. Look, this tragedy, and it is a tragedy, shines a light squarely on the delicate nature of the infrastructure, if one can say that, not just in Baltimore, but it's going to become a national issue, isn't it? This spotlight on infrastructure.
Absolutely, Manus. Now, we did hear from the Transportation Secretary, Pete Buttigieg, on this yesterday. He said there would be no reason for Americans to be concerned about the security of other bridges. Frankly, he said that no bridge is built to withstand a vessel of this size colliding directly into one of its support beams. And Governor Wes Moore also yesterday said that this bridge was up to code. This really ultimately was just a tragic accident, it seems. But yes, definitely puts a spotlight on the infrastructure. And also, when this bridge is reconstructed, how should bridges be different to now better coexist with vessels of the size that we are seeing now in the modern age, that in the way that trade flows are going to be questions we're dealing with in the months and years ahead.
Kayleigh, thank you very much. Kayleigh Lyons on the ground in Baltimore. Let's take a look at the economic impact of the bridge's collapse. Mike McKee is with me. Mike, this is from physical coal through to autos. What's the size and the scale of the Port of Baltimore, its impact if it's going to be out of commission, out of usage, let's say, full-scale usage?
Well, it isn't that big of a port, and that's why it won't be a major national impact. Obviously, for the people of Baltimore, it is a major tragedy and will cost a lot of money. But as you can see, there are 8 ports along the East Coast that are fairly large. Baltimore's the 4th largest. And some of those others there in New York, in Norfolk, in Savannah are already taking some of the cargoes that had been destined for Baltimore. So there is relief on the shipping side. It may be important the most important thing may be how quickly they get that harbor opened again. That's up to the Army Corps of Engineers. But the Port of Baltimore is only the 17th largest U.S. port, and it only handles about 1.6% of U.S. waterborne tonnage. That from the latest figures in 2021. It was the largest port, though, for automobile imports and exports. Savannah has good capability for that, so they may pick up a lot of that business. Maybe some of the real impact would be in rerouting truck traffic through Baltimore. It will slow deliveries in that area, but according to logisticians, is that the word I'm looking for? And the folks at places like FedEx and UPS, they can work around it fairly quickly. There is a question about inflation. This is automobile inflation, new cars and parts. Those prices have been going down. So it does appear that it isn't necessarily going to be a huge problem for inflation. May hold up the inflation numbers for a little bit, but it doesn't seem to be something that is going to be a major impact. So again, for Baltimore, a real tragedy and a real problem, but for the overall U.S. economy, not so much.
Yeah, indeed. And just confirming that, you got Michael Ferroli over at JP Morgan talking about a minimal, likely only a minimal implication in terms of vehicle inflation. That stuff coming in from Canada and Mexico being quickly diverted. Mike, thank you very much. The context on the economy coming up, your morning calls. And also we'll be joined by Gerry Keefe, co-head of global banking coverage at HSBC, to discuss his view on capital markets in 2024. That's at 9:30 a.m. Eastern. Down. We've managed to reassert the momentum in these markets to the upside. You've got the drugs maker Merck on an FDA approval for their high blood pressure drug doing well. But we've got this momentum on the upside. Tesla is taking a little bit of a hit. BYD missed by the smallest of margins in China this morning. There's Tesla managing to eke out a gain of 2.2%. We'll just update that in a moment. Let me tell you what else is going on, what the scribes of Wall Street have got for you. HSBC initiating coverage on Spotify with a buy rating. $310 as a price target, seeing large opportunities ahead and a strong growth outlook. Next up, Redburn Atlantic downgrading Visa to neutral. The analyst issuing a cautious outlook for the company, thanks in part to the threats from digital wallets. And finally, Raymond James initiating coverage of Yelp with a market perform rating. The analyst says visibility into the macro environment, that remains low. Up next, we're going to have a conversation. We're at the end of the first quarter for the banks, the global banks. HSBC's Gerry Keefe joins me around the desk to talk all things markets and the business of banking on a global scale at HSBC. Good morning from New York. The bid is back. We're counting down to the cash open, up 0.6% on the NASDAQ. Tesla manages to turn it around despite the sort of slight wobble in BYD this morning. The momentum in this market, we've just had a conversation with Laurie Calvasina. She still says that this momentum is there, 5,500 on the way up. We're bid up this morning. The rest of your market action looks a little bit like this. You've got your 10-year yield ticking down a couple of basis points. Asset managers, real money net longs are the lowest since July 2023. On top of that, you've got a whole other issue going on with dollar yen. You've got the Bank of Japan, the Ministry of Finance drawing a line in the sand. Enough is enough. They are ready, we understand, to verbally intervene. But to what extent are they prepared to actually put their money where their mouth is and actually intervene as they did in 2022? For now, Brent crude down 0.5%. You're just seeing various opinions out there about what OPEC Plus may do when they come to the June cuts. And good old JP Morgan, they're talking about $100 oil again. We're all saved. Brent crude trades at 85.72. Well, there's one stock to watch. It is Carnival at the Open. The crews are reporting results seeing $10 million impact from this bridge incident in Baltimore. Abigail Doolittle has the details. Abby.
Manus, that is the big deal coming out of this report, because initially the stock was up more than 3% because they basically beat and the outlook is pretty solid. But they also did say that they expect exactly what you just said, that the Baltimore bridge collapse could result in a $10 million hit to their 2024 income. They do, of course, have many cruises going out of the port of Baltimore, cruise lines unable to get in there because of the tragedy, that bridge collapse. So right now it seems as investors are going that way. The stock heading to its worst day since January. In terms of what was right, though, they did beat in terms of earnings. They put up a narrower loss than expected of 14 cents. EBITDA of $871 million was better by about $50 million. And they put up record revenue, $5.41 billion. All of this coming out of the pandemic. The revenge travel, adjusted earnings a little bit light, EBITDA better. But it really does seem as though investors are stuck on that headline that they are seeing a $10 million hit potentially in their 2024 income as a result of that tragic Baltimore bridge collapse.
Abby, thank you very much. Let's talk about some meme stocks. You've got GameStop seeing the biggest drop since June. That's after their revenue plummeted. Alex Semenova has the details. Alex, good morning.
Hey, Manus, good morning. GameStop's results were so disappointing to Wall Street this morning that Wedbush analysts said they expect the demise of the company as soon as later this decade. Net sales came in at $1.79 billion in the fourth quarter. That's a 19% drop from a year ago. Shares are down about 16% right now. That places the stock on track for its biggest decline since June. Now, this comes after GameStop enjoyed a bit of a meme stock party in recent trading sessions after the Federal Reserve signaled that it would cut interest rates this year. The stock had gained about 18% in the prior two trading sessions. That party is clearly over now, at least for GME. Baird Equity Research said it has limited confidence in the company's ability to restore growth and drive operating efficiency. Now, interestingly, Manus, you remember last quarter, the board had awarded CEO Ryan Cohen permission to invest in equity securities and manage the company's investment portfolios. They actually scaled that back under the new policy. The board has delegated that right to two board members in addition to Cohen. Manus.
Alex, thank you very much. Joining me now is Gerry Keefe, co-head of global banking coverage, head of global banking for the Americas region within HSBC. He oversees the bank's CIB, the capital markets activities, the corporate and financial institution clients. He is a busy man. We'll tag on private equity for good measure. Good morning. Good to see you.
Morning, man. It's good to see you.
You're the busiest man, one of the busiest men on Wall Street. So we appreciate you taking the time today. If I look at 2024, it started with such bullishness and euphoria. I come to the end of the first quarter, I've got job cuts, I've got people maybe just stepping back from that level of exuberance. Has it peaked?
Look, I think we're coming to the end of the first quarter, which will have been the biggest quarter in investment-grade debt issuance in history. It'll be the third biggest quarter in history for leveraged loan issuance. The markets are wide open. And so for us, it's been an extremely busy quarter. We're seeing healthy activity kind of across the piece. We're seeing it, as I mentioned, through investment grade, but also in the leveraged loan and broadly syndicated and private credit space. All of these engines are firing right now for the capital markets and for the banks and financial institutions more broadly.
Do you think they're still firing on full momentum, or is there any hesitation at all creeping in?
Well, look, right now, I think part of the reason the year's been so front-loaded is we have an election in the back half of the year. And I think everyone who's looking at the market from the issuer side and the investor side see a lot to like. From the issuer side, spreads are kind of in the bottom 10 percentile of history in the last 20 years. And from the investor side, all-in yields, based on where we are in rates, are in the top 90%, the 90th percentile of where we've been in the last 20 years. And so both are fully engaged, both are at the table, and we're just continuing to see activity come through the chute.
Okay, so if the activity comes through the chute, looking across, I mean, you have a broad church to look after. If I said to you across that suite within investment banking, DCM, ECM, where is the strongest momentum? And perhaps where's the strongest momentum going to continue? And let's just cast it forward.
Look, I think the financing markets on the debt side have really been the engine so far this year. Equity's showing signs of life, as you've seen. We've had a couple of names come through in the IPO market, and hopefully that's a harbinger of positive things to come. M&A is spooling up, though. If you think about the most important participants in the M&A market, it's our financial sponsor clients. They represent year in, year out about 40% of the volumes. In the last couple of years, things have been pretty quiet. Last year's activity was off 35% from 2021. We're now seeing real conviction around engaging in processes, people on the sponsor side really willing to dig in and do the work because the financing markets are there. The economy is in good shape. People are no longer worried about things falling off the cliff that we were last year. We're seeing that kind of terms, structure, and pricing are all kind of coming the way of asset owners. And
it sounds like a loaded gun. But what's the distance between powder in the gun and actually pulling that trigger?
Honestly, it's just time. I think it's time and kind of a continued positive tone in the markets. For sponsors in particular, when you think about the opportunity set in front of them and the amount of pent-up demand there is, both on the corporate side for things like carve-outs and asset reconfigurations, and from the sponsor side on the interest in transacting on assets that are currently in portfolio, there's a lot of interest on both sides. And now that the financing markets are really there and at the table, we're expecting to see some activity.
What do you make of the argument that a number of deals, a number of protagonists, a number of equity market deals, debt capital market deals were being restrained because of the lack of impetus from the Fed to cut? Here we are, we can debate whether it's 3, 2, 1 or none.
Yeah.
But what do you make of that thesis?
Well, look, I think the most important thing for people who are trying to price assets and trying to transact is having an understanding of what the overall path is on rates. We don't necessarily have to know the exact landing point. Last year, there was a lot of uncertainty around the path of rates because inflation was bouncing around. People didn't know whether the next move from the Fed was going to be up or down. You had Richard Clarida on earlier, I saw, so we'll consider that topic well covered. But I will say that, now that people feel comfortable with the general path of rates, that the economy is in relatively good shape, and that, terms, pricing, structure, and kind of general access to markets is open, I think you're going to see things move.
So are you the right size at HSBC? I've got other institutions cutting. Whether it's 20 jobs at one shop, whether it's a couple of hundred jobs at larger shops, are you fit for purpose in size? Have you got the right people in place to deal with this flow that you've just outlined?
Look, we've got an exceptional team here and globally, and I think we're right-sized for it. We'll continue to see all the banks adjust. Banks rarely have it exactly right at any point in the cycle. I've been in this business for 25 years now, and it seems like someone is always hiring up or cutting people.
Where are you in that cycle? Are you in the hiring up or are you in the prepared to cut?
Well, you probably saw some comments from my global boss, Greg Guyette, last week about an interest in hiring up, both on the investment banking side and in project and infrastructure finance. We believe we're entering a golden age of project and infrastructure finance globally, particularly in markets that are really important to HSBC around Asia and the Middle East. The Inflation Reduction Act here in the U.S. has proved a huge catalyst for our global clients to be investing here, and so if anything, we probably have needs.
Okay, so golden age, get your CVs in there. Gerry's inbox will be full at the end of the conversation. Yeah. Let's deal with one of the big announcements, which took a lot of the heat, I think, out of the earnings day, which was commercial real estate. It's a very hot topic here. You slashed your exposure by 27%. The question that goes through the market's mind is, have you got much more work to do? Are you happy? Are you right-sized at the right level?
Look, I think on CRE generally, this is kind of the most rate sensitive and the most leverage dependent asset class out there. And so when you see what's happening with rates and you see that kind of banks are slowly but surely and other providers of capital are slowly but surely coming back into the market, you have to conclude that the bottom is behind us. I usually think you find the bottom when you can't find anyone to say anything good about an asset class, and I think that was probably Q4 in CRE land. And it's important to disaggregate CRE. There's multifamily, there's industrial, there's logistics, there's data centers around AI. All of those are doing quite well. We're really talking about Class B and Class C office. We just moved into a new Class A office over in Hudson Yards. The lease up it's apparently turned into a food fight in our building. And so I don't think anyone's particularly worried about new Class A. It's really B and C.
Do you think there'll be other shoes that drop in Class B and Class C that could be, I suppose, market disruptive? We're trying to look for those disruptors, aren't we?
Look, we are. I think it's a bit of a bank-by-bank analysis. I think you just have to understand for each bank what their exposure is to CRE and what part of CRE there is in there. I think when you try to make an assessment of a bank based on the total amount of CRE exposure, have you either risk overstating or understating the risk, depending on what sector they're invested in, right?
Then if I said to you, where are you most uncomfortable with your CRE exposure before we move on, where is that?
We're comfortable with our CRE exposure.
You're comfortable with that, and you don't agree with Carson Block. We're in the foothills of 2007. He's just selling something. He's selling another dream or a nightmare, is he?
Well, Carson Block's in the business of saying things like that.
You talk about a golden age. I'm just wondering, when you look at the pools of capital, you've got China. We'll talk a little bit more about that in a moment. But where is the biggest depth of origination going to come from, let's say, for the back end of 2024 and into 2025, in your view?
Look, I think globally what we see, and we should talk a little bit about the Middle East and Asia and Europe. I think, obviously, the U.S. market, which is kind of my primary area of responsibility in global banking here, I think that's well covered and well understood, and I think it's basically go time in the markets here. Now, in the rest of the world, the story is a little bit more complicated. In the Middle East, for example, I think the Middle East is probably the only place in the world right now where you're seeing announcements of $40 billion funds to invest in AI. That's probably the most important pool of capital between the Middle East sovereign wealth funds and the Asia sovereign wealth funds that are out there right now. And I think when you think about what the level of investing is going to be and deployment is going to be and the need for leverage to support that deployment of capital is going to be, I think you have to look to those parts of the world because they're very much open for business and continuing to be ambitious outbound. One of the most underreported stories that we've come across in talking to our clients is the China outbound story. So China is right now entering probably a second wave of outbound activity where their corporates are investing overseas. So the automakers are all investing in Thailand, they're investing in Mexico, the battery companies are all invested in Hungary and Romania. This type of activity often it creates, as we see what we call a reglobalization, creates a lot of opportunity for HSBC's global franchise to sort of step in and support these clients as they make moves outbound.
As you see that flow of money and that global investment coming out of China, is that going to be your biggest growth initiative? Is that going to be one of the strongest flows for you from China, outward investment rather than inward, rather than domestic investment?
It's certainly an important one, just because we have an incredibly strong franchise there, right? We've been in China for almost 160 years, and we built up a lot of quality relationships. So when they look to go outbound, we're the bank that they know and trust most.
Let's just revert back to the Middle East. I'm duty bound to ask: Are you on the Aramco, the additional IPO Aramco ticket? You signed up?
Look, we don't comment on specific client matters. As I understand, you have to ask, and I appreciate that. It would obviously, given the strength of our franchise there, would make sense, but that's not something we comment on. We're the only bank to have been on top of the league tables in each of the last 3 years in both DCM and ECM. So we've got an incredibly good franchise there, really high quality, and I think we'll continue to press that advantage.
What is their ability to raise $20 billion in this market say about war, geopolitical risk, and the Middle East?
Look, I think the geopolitical risk is kind of always there. And I think you have to think about from the perspective of what is actually happening with the funds that get raised from the Middle East. This is about diversifying their economies, right? This is about investments in tech, in healthcare, in life sciences, in infrastructure, in the energy transition. Those thematics, I think, will continue. Obviously, no one wants some of the negative situations that we have out there right now. But at the same time, I think we feel pretty good about the ability to deploy capital in those areas.
Gerry, stay with me. We've got more to discuss. That's Gerry Keefe sticking around for more on his perspective on the world and global banking. This is Bloomberg. More conversation now with Gerry Keefe, co-head of global banking coverage at HSBC. You said it was go time in the USA. I mean, explain.
Well, look, I think it's been a long time since we've seen financing markets that are this open for this range of borrowers. I mentioned earlier that we're seeing action both in the broadly syndicated market as well as the private credit market. We view those markets as complementary. They're both wide open for borrowers. And I think the ability to kind of put on risk from the investor standpoint is something that they're welcoming at this point because it's been a little while.
I mean, we have, look, lots of superlatives are used. Yeah. We have euphoria. We have 5 months on the run in quoted markets. We're breaking records after record in equity markets. But I look at credit spreads. They are so tight. They're wound up so tight. Is there anything that can stop the path of that go time?
Well, of course. I mean, look, we're in the business of taking risk, and so we're in the business of worrying about things kind of day in, day out. I think, broadly, there's a lot of volatility in the second half of this year. That's, as I said, part of why the first half of the year is going to be so good. So I think people are trying to stay out of the way of that volatility in the second half, driven mainly by the election and, potential action or inaction by the Fed. So that's one. Two, I do think we see a little bit of softening in credit generally. We may be past kind of the moment of peak improvement. And when you look at the number of defaults that we've had this year, I think S&P just reported that we've had more defaults this year to date than any year since 2009. So there's a bit of distress out there. I would observe that most companies have been relatively conservatively managed and are cashed up in the last few years. And what you're seeing is really companies who kind of during the go-go days levered up and were more or less dependent on rates remaining low in order to be able to support the capital structures they have. Running a levered company at high rates is, it's a little bit like doing a plank or something. It's kind of easy for the first 30 seconds, and then a few minutes in, you're kind of turning red and falling over. And so I think we're seeing a little bit of that with companies that have very heavy capital structures on top of the equity.
I get to about 30 seconds and then I completely fold. But exactly, it's all about gym work. From a risk committee perspective, and we debate endlessly here at Bloomberg whether banks are taking more risk, scaling back. You've talked about CRE. Where is the risk committee at HSBC at the moment in terms of global risk? Is there a hesitancy or is it all guns blazing?
Look, I think we're really where we've always been on risk. I think part of the reason that HSBC is rated and regarded as well as it is in the market is that we take kind of risk consistently and with a lens that takes into account the global perspective that our clients give us and that our bankers bring back. So we're kind of neither more or less on risk or off risk than usual. We have a pretty consistent approach.
Please enliven the debate for me. What are we missing? I spent day in, day out asking the same question. I'm like a nodding dog, 3 cuts, 2 cuts, 1 cuts. What is the more important issue that I've missed, that we're missing? In rates debate? In the rates debate,
look, I think the Fed has been pretty clear on what their intention is. And I think, the traders have been on the wrong side of that, and that's, unfortunate. But I think in reality, the ultimate path is what's important, not kind of where this winds up. Are we going to be, 150 basis points lower in 6 months' time, 9 months' time, 12 months' time? The point is that people can price assets and transact based on a view on the path, not where it ultimately lands.
Tell me just briefly to close off here, you've been in this job 3 years. I want to understand what kind of culture you run, that you drive, that you want at HSBC. Colin Kelleher has a smell test for Credit Suisse bankers coming in. What's your smell test? What's your culture?
A smell test. Like, I don't really know what to do with that. I joined HSBC 3 years ago, and I think probably a bit of the reflection of our CEO, Noel Quinn, who I know you know well, is that I was given a very kind and welcoming reception. And I think that for people that are client-facing, that's how you want to make them feel. You want to make them feel good coming in the door, because our business, to me, it begins and ends with clients and how you make them feel, and are they kind of confident in your ability to transact and execute for them. And I think by making people feel like they're being subjected to a smell test on the way in the door, that may not be the optimal path.
Gerry, thank you very much for giving us your time this morning.
Absolutely.
You're right, the smell test may not be the optimal path. Ill phrasing by me. Thank you for giving us your time this morning. Come back, tell us how those deals crank up. Gerry Keefe, head of global banking coverage over at HSBC. Let's get into some price action this morning. Back to Abigail Doolittle. Abby.
Well, Manus, right now we are looking at a gain for the S&P 500 of about 0.6%, the best day in a week. All 11 of the S&P 500 sectors are higher, led by utilities. That, of course, is a defensive sector, so there's not the most risk-on tone around that, but nonetheless, 3, 4 sectors up by about 1% or more. The worst sector, energy, up just 0.1%, in sympathy to some degree with oil down. Now, before we take a look at the cruise lines, or as we take a look at the cruise lines, we also have news on Reddit, one of its first down days in its 80% pop over the last week since IPOing. There is a firm adding it to its short list, that is Hedgeye. And then take a look at the S&P 500 hotels, up 0.3%, a little bit more. Carnival, of course, a drag, down 1.8%. This after a little bit of their guidance is somewhat disappointing. Adjusted earnings slightly light on the year. But again, there is that headline that they see the Baltimore Bridge collapse resulting in the potential of a 10 million hit to their income for 2024. So again, that stock down as investors try to parse through those details, Manus.
Abby, thank you very much. Coming up in the show, market moving events, setting your agenda on this shortened trading week. Your trading diary. It's a bleak, overcast New York. Good morning. Time now for your trading diary. What you need to be watching. We've got Fed Governor Chris Waller speaking at the Economic Club of New York. That's tonight. Thursday, Sam Bankman-Fried is scheduling for a sentencing in New York. Plus, we'll have another round of jobless claims Friday. Takes us to the close of the week. We have the US PCE data, and the Fed Chair Jay Powell speaks. Plus, US markets will be closed on Good Friday for holiday. The only thing you can probably trade is Bitcoin. That was Countdown to the Open on Bloomberg. Good morning from New York.